everybody. We're going to go ahead and get started. Welcome everybody to our executive pop-up series. And today on our executive pop-up series, you have seen them before and you will see them again this afternoon. We are going to be talking about the evolution of PPP, significant childcare tax benefits, and the next round of stimulus, which we just heard 2 nights ago. A significant update has come through. So we brought on John Rizzo as well as Matteo with RDG+Partners, and we will be going through those elements in just a couple moments. So let's go ahead and get started here. And one of the elements I'd like to do, or one of the things I'd like to do, is go through our agenda. We are doing our welcoming, and just as a reminder for everybody, if you do have questions, please use the Q&A button, not the chat feature. The chat feature won't have questions taken from it if we have time for questions. We do have a relatively full agenda today, but we will hopefully get to questions. And if we do not get to your questions on the webinar, we certainly will get back to them after and send them out to everybody. This webinar will also be available for replay too. So everything is being recorded, and you will have a chance, as being a participant that has registered, you will get a copy of this webinar to go back through. With that said, we also produce a certificate for those of you who are seeking a certificate for your continuing education. There is a certificate that will be produced from you coming through and registering and finishing the webinar with us. And so with that, we'll move in a moment. I'm not sure Alex has joined us as of yet, but Alex Hall will join us just for a few minutes to talk about childcare relief. And if not, I have a solid understanding of it, and I do want to make sure that we do address it. We will then go into housekeeping and talk about a few of our solutions that we've been bringing to all of you, members and non-members. And then we'll get into the introduction of John and Dan, and then go through the PPP forgiveness updates, and then do some Q&A work. So with that said, let me go ahead and see. I'm not sure if we do have Alex on as of yet. I do not see her as of yet on, but let's go ahead and move into the child care relief. As many of you know, both the Senate as well as the House have been contemplating a package for child care relief. As we know in our industry, it has been significantly challenging. I think most of you know that I own and operate my own centers, and I do recognize that with my centers, we've had significant challenges on all sides of it. Most recently today, I've learned that we have an issue now where staff members, because of how kids are going back to school with such scattered scheduling, our staff members are now fearful that they may have to quit or be off of work for a period of time just to manage their children's schedules, because they're not sure how to handle it, because the kids won't be in school all day long. So there is a litany of needs that we have from not only PPP, but revenue replacement, support for our staff, support for bringing the right type of staff in, and training and things of that element. What Hans will be doing is in the chat function, he will be posting a link. This is a very simple link. It is set up for your state. And this is to have your voice heard. It will reach out to your state senators and let you know that this is an important issue to you. It takes literally less than 3 minutes to do the entire thing. So I would ask all of you, if you could, to participate on this to help our industry. So thank you very much for that. And I'm truly appreciative of that. Let's also talk about next week's webinar. So with next week's webinar, we have, I believe, a rather important webinar within our realm with both our members as well as some non-members. We do have and have had a number of centers that have had COVID right in the center. And for that, it has become, for some of them, a crisis issue. For other ones, it has been an issue of uttermost importance in how they communicate. So in next week's webinar, on Tuesday, the 11th at 1:30 p.m. East Coast time, we are bringing on 3 of our owner operators in a town hall forum to discuss what had occurred, how they learned about it, how did they respond, how did the staff, the families, and the media respond to it, as well as what their valuable lessons learned were. I know a lot of us already have plans, a lot of us already have contingencies, but at the end of the day, when it actually happens, and it likely will happen. So that's why we say, not if, but when COVID-19 hits your center. We obviously hope that it doesn't, but it's not going away anytime soon. So we plan on having this webinar, and hopefully you can join us for this event, and we'll be happy to have you for the event. So with that said, what I would like to do is I would love to have you go ahead and get into some of our housekeeping. And the first part of our housekeeping is really talking about our member journey. For those of you who are members, we are rolling out to you our quarterly member journey. And what our member journey is, it really discusses when you are part of an IC360 membership. We are huge believers that you should have a significant return on your investment. We're in the business of trust, and we're in the business of transparency. So with that trust and transparency, we provide you as our member, or if you're not a member and you want to learn more about it, we provide you a quarterly report that shows you what you're currently using of our services, where you're getting a return on that investment, and where you have lost opportunity, and the dollar amounts that you could take advantage of. And we go through that with you on a quarterly basis with our membership advocate. So that is something that we have just put the final, the final wrapping on, and it is out and has been rolled out by Jen Guadioso, our membership advocate. We've also rolled out back in July, which is just a month ago, not even, it was our rollout of IC360 ECE Healthy Advantage. This is our hopeful solution for what I call the donut hole in the child care area, where staff members, administrators, and the like have a very difficult time paying for a major medical. Yet they oftentimes are above the poverty level. So if they were to go to the state exchange for healthcare benefits, they still have to pay a significant amount. You as owners oftentimes have to pay an awful lot, whether you are a small entity that has under 50 FTEs, or if you're larger and you have more than 50 FTEs, you have a conundrum. And I've oftentimes had to consider with my own staff and my own centers, if I was to want to expand, but not that much, I would have to pay some significant additional dollars for healthcare benefits, which really could hurt my overall business model. So over the past year and a half, we built out IC360 ECE Healthy Advantage, and it is a healthcare plan that offers a number of different benefits. First, it's very affordable. For per payroll, which would be like on a weekly payroll, an employee could pay anywhere from $11.50 at the low end, all the way up for a whole family plan of $90. But they get a comprehensive plan. It offers 5 different program options, and each one of them has telemedicine in it. It is very easy to roll out these plans because you, as the owner operator who may take advantage of this benefit plan for your staff, do not have to roll it out, do not have to manage, do not have to answer the questions for it. That we have, as part of our plan, set up an enrollment specialist team and a benefit liaison who does all the rollout in conjunction but with you, and manages all the questions your staff may have. And just what is needed, it is a substantial plan, anywhere from just wellness to having plans that offer $15 office visits, $15 for a specialist visit. It is scaled to what your staff really needs, and it can be either for someone who can't afford major medical, or may have a program that is in addition to major medical because they have such a high deductible. It is very staff friendly. We are speaking ECE, childcare language in everything we do. And we understand, for instance, when the enrollment specialists have to talk, they can't call in the middle of the day because people are in ratio, they're in rooms. So it is all focused on our industry. And we believe that we're delivering significant value because the availability for it is throughout the US in all states and has significant offerings for those in major metropolitan areas too. It serves our members because we believe in the trust side of it, and we believe because of our combination of our knowledge at IC360 in childcare, along with the expertise of the broker benefit enrollment specialist, that the plan is significant. And just want to let you know, since we rolled it out, we've already had 20 companies, some of our members, some of them are non-members, already join us. It takes about 1.5 to 2 months from the time you say, yeah, I would love to move forward with this, to the time you can actually roll it out. So just keep that in mind. And if you want to learn more about it, just go to benefits at InspireCare, email benefits at inspirecare360.com. You can also make mention to it in any of the registrations that you have and coming to our events, as well as if you work with, obviously, Jen Guadioso, our VP of Membership Advocacy. She can tell you what you need to do for it. With that, we are bringing on the gentlemen who are also our financial experts. We now put together a program, and they do upfront for our members a pro bono evaluation and look to support you when it comes to what you do financially and what you're looking at for your key performance indicators. And then we've had a number of members who've looked at it and have decided that this makes a lot of sense for them because it's so many dollars that they're leaving on the table in the childcare business. And this is all about increasing your profitability, your efficiency, and your optimization of your operations. So both John and Dan lead that effort. And it has been, we've received rave reviews. You receive reports like this where it talks about your industry averages, your peer groups, then looking at your previous years, looking at where you've actually done very well, but where there's small opportunities for you to change some small things, as well as large opportunities that you can really get at to make marked moves on your overall balance sheet, the P&L. And so with that, I'm going to go ahead and introduce Dan and John. I have Dan right on the screen. I know John is there too. I saw him walking in. How you guys doing?
Great. Good.
Awesome.
Thanks for having us.
Love having you guys. And thank you so much for making yourself available to us too, since I know you guys have been wildly busy in these PPP days. So with that said, today's topics, there's a number of different things with stimulus that's going on, and Dan and John are going to talk about guidance on the applications, as well as different facts of covered costs incurred prior to you being in the cover period, as well as what do the owners forgiveness starts to look like depending on the kind of organization you have, clarification on elements about interest, whether it be for secured on the unsecured debt that's included. And I'm really interested to also know is if they have decided to give us any tax breaks yet on the money that are, that has come out for PPP, because that can be a significant burden for next year. And so also learning a little bit more about 2 reduction tests. And so with that said, I am going to stop sharing and I'm going to hand it over to Dan with the Hustle Firm and have you guys start your program.
Awesome. Thanks, Tony. Can you see our screen?
I sure can.
Awesome. Well, special thanks to your team over there for using your technology today and getting everything going. So thanks everybody for attending. We're excited. We haven't seen you guys in like 2 months. So we missed you guys and we're excited to be here today. Thanks for taking some time out of your day and especially for pushing a little later in the afternoon than you're used to. Again, we always remind everybody, we hope you're staying safe and healthy, as Tony's webinar alludes to for next week. It's not a matter of if, but when. So just stay healthy and stay safe. And big thanks to our research team internally. They've been crunching the numbers, staying up on legislation, working through all the latest guidance, the most recent guidance that came out on the 4th, which is only a couple days ago. So you're getting the latest and greatest up-to-date information here today. As you know, Tony mentioned, John Rizzo, Dan Matteo, myself, we're both CPAs here in upstate New York, and I'll be going through the PPP stuff today. Hans has kind of already teed us up on the technology, so feel free to put those questions in the Q&A section of it. I've already answered at least one, and we'll get to as many as we can today. And Tony's going to give you the slides and recording after. We'll make sure we get our slides to him as well. So our agenda is pretty simple, pretty quick. We want to keep it short and sweet. We're going to go through a news review over the last couple months, what's changed, a little stimulus recap, and then we'll do a quick Q&A if there's time at the end here. So with the news review, one thing that's actually not in my news review that Tony made mention of, so let me address it, is the tax update. There's been no news, unfortunately, on whether or not Congress is going to ease the taxation of this. So as a reminder, Congress, when they drafted the CARES Act, said we want none of this stimulus money to be taxable income. The IRS came behind the Congress and said, well, that's great that it's not taxable income, but you then cannot deduct the expenses that you're reimbursing. People were like, well, that's kind of a bait and switch. So now basically the money that I just got is taxable. Nothing's been done for that. We don't anticipate anything to be done. They can't even agree on the latest round of stimulus packages that are out there. So we don't anticipate anything to be done until at least November or December. So stay tuned on that. If we get an update, we'll obviously pass it along to Tony and his team, who can blast it out to you guys. You know, we always go through who the players are. It's important to know who in Congress and who is involved in the negotiations in case you need to reach out. So that's Marco Rubio, Schumer, Pelosi, McConnell, Kevin McCarthy, and obviously Steve Mnuchin. Mark Meadows is also playing an important role in the latest round of negotiations. So if you need to reach out to Congress or your representatives, please make sure you do so. And then really the big thing over the last couple of months has been about disclosure. So if you haven't already heard or haven't already searched the database, there is a database out there. If your loan was over $150,000, you can search the database by name of business, number of employees and jobs retained, industry code, and an approximate value of the loan. So that is out there. It's public information. If your loan was under $150,000, you can't search the actual business name, but you can see the demographics by region. So that is out there. That was a big thing. And again, all of that related to transparency. So everyone said there's a lot of money out here. We want to avoid fraud, and we want to make sure people know who got the money. So they came up with that agreement. So the ranges are $150,000 to $350,000. You can see the names of those loans: $350,000 to $1 million, 1 to 2, 2 to 5, 5 to 10 million. And you can see an approximate range of what people got for money. So again, nothing under 150 is going to be released. And then the biggest news 2 days ago was that if you haven't heard, or if you've been wondering, when should I apply? You know, my banks are not ready. Nobody's ready. I'm worried that I'm not the first in line. That's not the case. The SBA is not accepting forgiveness applications until the 10th. So that's in a couple days. So even if your bank has taken your application, the SBA has not. We anticipate further easings of the requirements for forgiveness, and therefore we're not encouraging people to rush through the forgiveness application, though we want you to know the current rules as they stand. We hope that there's going to be further easing on those requirements to get your loan forgiven. And we have told most of our clients at this point, hey, take your time. Don't rush through the application. Don't fret on the application until the SBA actually opens up its portal. So you're not last in line. It's not going to be like applying for the money itself. Take your time. Don't rush through the application.
Hey, Dan, regarding that, let me ask you a question, if that'd be okay.
Yeah.
Regarding forgiveness, let's say right now you've hired everybody back and you had everybody back like you originally planned by July, because that's what PPP, or the end of June, that's what PPP initially said it was going to do.
Yep.
It was looking for that period. So you rushed, you went out there, even though you didn't need them, you hired everybody back, you got that number back. But now you see that, you know, schools are wavering in the fall. Not everybody, it doesn't look like all the families are going to be coming back in the fall because of that. And in turn, you may not need staff. So there's a possibility in June of this year, because of the initial PPP, you may have more staff that you hired back because of PPP then than you may have in this fall all the way up to December. Are you able to draw a line in the sand, to your knowledge, between June or August or November or December, whenever you had the most, and say, this is our filing date?
Yep. Yeah. So a couple of things on that. There's been a lot of talk about that. That's been in the HEROES Act and in the HEALS Act. If you followed both of those that have been in draft, remember the HEROES Act is the Democrats' plan. The HEALS Act is the Senate Republicans' plan. There's been a lot of talk about, number one, just easing the restrictions and saying, did you make a best effort to bring everybody back and keep as many people as you possibly could? And as long as you were hiring whatever you could to support the level of business activity that remained. So, so that's number one. Number two is if you were operating under the rules of the 8-week covered period, which ended and said you need to hire everybody back by June 30th, you can draw that line in the sand on your application as it currently stands and says, hey, yeah, I hired everybody back by June 30th. Therefore, I meet the forgiveness restrictions. And there's numerous forgiveness FTE reduction exceptions that would say, you know, okay, this person resigned, the level of business activity couldn't resume because of CDC guidelines, et cetera, et cetera. All these things that John's going to go through in a couple minutes. So if you are operating under that 8-week covered period, that's your hard line in the sand. Once the portal opens up, you can make that your hard line in the sand, or you can make it the 24-week period at the end of the year. So there's lots of different options. I think the intent of Congress right now is to make it as easy as possible to forgive the money as long as you made your best effort to hire everybody back.
Thank you.
All right, so what's changed? So over the last number of months, as we've been covering, as you guys have been following along, there's been a huge uptick in, so they released the application and some of the rules in the CARES Act, and then there's all these rules that followed that clarified treatment, expanded the eligibility, extended the time period, et cetera. You can see here a short list of all of the interim final rules that have come out. So what we did is we summarized these rules, and we said, what was the old rule? What's the new rule? So we'll just go through some of those right now. So the application due date originally was 10 months after the 8-week covered period. Now you can apply for forgiveness anytime prior to the maturity date of the loan. So as I just reviewed, you have, the SBA is not even accepting applications until the 10th. You have any time prior to the maturity date of your loan to apply for forgiveness. However, something to note, and this is in the last line there, that your first payment is due 10 months after your 8-week covered period. So if you have spent all your funds, you do want to try to get that application in as soon as you know that you've spent the funds and you are eligible for full forgiveness. After you submit your application, the bank has 60 days to review it and submit it to the SBA, and the SBA has 90 days to approve it. They can either approve full forgiveness, approve partial forgiveness, deny it, or deny it and ask the SBA to review it even further. So nothing's really changed in terms of how long the banks or the SBA has, but there is longer period of time for you to apply for forgiveness. Second things that have changed. Originally, when there was only 8 weeks for you to have a covered period, you could take 8 weeks worth of $100,000, and that's what you could be reimbursed for each employee. That amounted to $15,384. Now, obviously, if you use the 24-week covered period, you can use 24 weeks of $100,000, which is $46,000. However, for owners, because they don't want to see abuse, and this plays in with how Schedule Cs are taxed and how Schedule Cs apply for forgiveness, they're only allowing owners to take 2.5 times their 2019 profit or their 2019 wages, whatever is less. So if you paid yourself in 2019 $50,000, you can only take 2.5 times of that, which is about $10,000, versus if you paid yourself $120,000, you can take the full amount. So owners are limited less than employees are. For payroll, under the old rules, you were limited to the maximum amount of your loan is how much you could spend on payroll. That kind of tripped people up, and as we went over on a previous webinar, if you had an FTE reduction, you multiplied that by your loan amount, and that would mean that you have to pay some of this money back. What they did, what the purpose of this is that you can spend far more than your loan amount on payroll to offset the reductions in FTEs or the wage reductions. And that just helps you get more of your loan forgiven. So what it's important to do is if you have laid people off, or if people have quit, or if you reduce people's salaries or their hourly rates, it's important to make sure that you look at your 8-week covered period versus your 24-week covered period. And that's something that if you can't do that on your own, or if they don't restrict those, that's a situation where you'd call us and we can help you work through that. For any of you that have your centers taxed on Schedule C, as opposed to an S Corp or a C Corporation, it's taxed on your personal Schedule C, your personal income tax return. You previously were only allowed partial forgiveness. Now you're allowed full forgiveness for your loan if you're a Schedule C owner with no employees. So big changes there. Moving forward, so before we didn't know if you were an owner and you had health insurance, how would you be able to include that amount in your PPP application? So when you said, hey, what are your payroll costs times 2.5 times? We didn't know if you could include health insurance. They've clarified and said if you were an owner of an S Corp, a Schedule C business, etc., you cannot include health insurance in the owner benefits when doing your application. Why am I telling you this about this right now? Because in the acts that have come out and in the clarifications that they're trying to push through Congress right now, if you did not get enough loan because you calculated it wrong, you might be able to amend your application and get more money. So for any of you that said, oh, I didn't know that, I thought it was just my employees, I didn't realize I could put myself in the application for more money, there may be an opportunity coming up here where you could actually apply for more money because you didn't calculate the amount correctly. Maybe you didn't use an advisor, maybe you just didn't know that that was included. So keep an eye on that. And if you did not calculate it correctly the first time around, you may be able to apply for more when this new legislation comes out.
Hey, Dan,
Yeah.
just for some clarification on that, before it says, with owner benefit, we weren't sure about health insurance, and now they're saying no health insurance, other than if you have possibly a C Corp. There's a number of people out there too who do have things like, and because you and I have been talking about this recently, they have holding companies, things of that nature.
Yep.
They have multiple locations. How do things tend to roll up? Any different that way in the structure of the corporation? Because a lot of us who have multiple locations have bought them under different tax IDs.
Right. Yeah, it depends. Like, without getting into too much detail here, what I can say is if you have a holding company, you could have a Q sub, you could have a C Corp holding company, etc. Usually your application is driven by your tax return. So if you have multiple centers under one tax return, you usually apply under one EIN for all of those centers. Versus if you have separate businesses, you would have tended to apply for a loan under the separate tax ID numbers because they're separate tax returns. That just makes the bank's job and the SBA's job a little bit easier. So if you have a holding company, it doesn't change the benefits line, but I would have hoped that if you had multiple centers, you would have included owner benefits, whether they were under the holding company or not. So it's important that you really say, hey, at the end of the day, Congress only cared that employees were reimbursed for health insurance, 401k, and payroll. So making sure that you include that, whether it's in a holding company or whether it's in a separate center.
Great, thanks.
Obviously, the huge headlines that we all know about by now is that you previously only had 8 weeks to spend the money. Now you have 24 weeks, which means hopefully you can spend all of your money. And then previously you had to spend at least 75% on payroll. Now you only have to spend 60% on payroll, and you can spend 40% on rent, utilities, and interest. So they ease the restrictions, although many people are finding that they're spending even more than 75%, more than 60% on payroll, and that is okay. The goal, and again, the intent is to get it into workers' hands. Keeping up with the theme here of extending the deadline, they previously, as Tony and I had just kind of talked about, allowed you to rehire everybody by June 30th. The new guidance is that you can hire everybody back by December 31st or the date of your application. So that hard line in the sand that we were just talking about is if you follow the old rules, it's by June 30th you have to hire everybody back. If you follow the new rules, you have to hire everybody back by December 31st or the date of the application, which for many of you, you may be pondering, hey, I might not have as many staff because the schools aren't open and people aren't coming to daycare. Well, if that's the case, you might want to apply as early as you possibly can so that you make sure to get full forgiveness. There's some strategy there for you. There are additional safe harbors that were clarified that said, hey, if you could not return to full capacity because you were trying to abide by CDC, Health and Human Service guidelines of social distancing, 6 feet apart, couldn't have, a lot of people in New York only could do 10 or 15 kids per room. Then if you laid off teachers because of that, you're not going to be penalized on your application for forgiveness. If you laid somebody off and they refuse to come back, that does not work against you. And if you reduce people's salary or hourly rate, you could remedy that reduction by June 30th or December 31st. Now, if you use the 24-week period and you reduce somebody's salary or their rate, not necessarily what they ended up taking home at the end of the day, but what you pay them per hour, if you reduce that, you cannot use the 12/31 period using the 24-week covered period. So that would be something that if you have questions on something, on a salary reduction safe harbor, you'd reach out to somebody, either look at the Treasury or give us a shout, and we can kind of work through those scenarios with you. And these are the two big ones that changed 2 days ago. Was we never knew what kind of loan interest was included in forgiveness. They had always said real property, which we always thought was, okay, interest on a mortgage. They came out in the clarification and said, as long as the loan is secured by real or personal property, you can deduct that interest. That would include like an auto loan. So for any of you that have cars or vans or buses on your center's books and you have a loan on those assets, you can deduct the interest as a non-payroll covered cost. And finally, everyone was also wondering, hey, what's transportation utilities mean? Does that mean I can deduct the gas on my car? And the answer to that is no. They specifically clarified a transportation utility fee is assessed by the state and local government. Though that's what's included as a non-payroll covered cost. So it's not the gas in your car, it's not the gas for your bus. So it's a very narrow definition of transportation. So that was a big clarification. So those are the big things of what's changed. Lots has come out in the last couple months, especially in anticipation of August 10th. So those are the big ones there. So now I'm going to kick it over to John. He's going to go through all those salary wage reductions, FTE reductions.
Great, thank you. Thanks, Dan, and welcome everybody. Thanks for spending the time with us today. So there are several safe harbors in this program. Some relate to salary and wage reduction, others relate to FTE reductions. And one of the major ones that was actually in this program was the Good Faith Certificate Certification Safe Harbor that basically says, do you even qualify for this money? So the first safe harbor for the PPP was related to that, and the requirement that you had to certify that current economic uncertainty makes this loan request necessary to support your ongoing operation. So in the beginning, a lot of people were nervous about that as to, do I even qualify? Well, clearly in the childcare business, a lot of you were closed for several months or weeks. You would certainly qualify because of that, but they gave you until the middle of May to say, you know what, I received money and I really don't feel like I qualify, and they gave you an opportunity to return that money. And then they basically came out with guidance that said, well, if your loan is less than $2 million, then you automatically have met that certification, which kind of put a lot of people at ease. For any loans over $2 million, there's audits and other things that are required, other documentation. So that was the first safe harbor that came out, and then all these other ones followed. So the salary and wage reduction. So if a borrower applies for forgiveness before the end of the cover period and has reduced any employee's wages in excess of 25%, then you must account for that excess across the full period. So basically, if you wait until the last week to reduce someone's pay, that counts for the entire period. So you got to be careful about what you're doing here with pay reductions greater than 25%, because your loan could be your forgiveness could be reduced because of it. So you extrapolate that over the cover period, and if you apply prior, it pertains if you apply prior to the cover period, and you compare those to Q1 of 2020 when you're looking at any sort of reductions. Next, Safe Harbor. So this is a cutout of the application, and it's the FTE Safe Harbor. So this Safe Harbor has to do with whether or not you've reduced employment, right? Because the whole point of this PPP loan is that you maintain your employees. That's a big part of it. So here are some of the questions that come into that. We'll get into these in more detail as we go through the next couple slides. All right, so here's a hypothetical. Number of employees during the base period was 10. Okay, so the base period, you had a choice to select a couple of different base periods, either the middle of February of 2019 through June, the end of June 2019, or January and February of 2020. Right, so those were the two covered the base periods you could choose from when you're comparing if you reduced your employees or not. So during the base period, you had 10 employees. During the pay period that included February 15, 2020, which we would call pre-COVID period, you still had 10 employees. During what we call the COVID period, 2/15 through 4/26, you actually increased employment by 5 people. So maybe you're in one of those industries or you're manufacturing masks or some other industry that actually increased the number of employees during this period. Number of FTEs during the covered period. So this is the period of your loan. Now you've reduced it back down to 5. So you went up to 15 and then dropped it down to 5. And when you applied, you were at 10. All right. So a few different numbers here going on as far as number of employees. So let's run this through the application. So the first thing we're going to do is enter the borrower's total average FTE during what we call that COVID period. So you had 15 employees during the COVID period. Now we're going to enter step 2, your FTE in the pay period, what we call pre-COVID, the pay period that included February 15th. At that point in time, you had 10 employees. So from step 1 to step 2, you actually increase your employees by 5. If that's the case, then this safe harbor is not applicable to you because you actually increased employment versus decreasing employment. So we'd stop there at step 3 and continue on with the application. All right, and this is basically, like I just mentioned, the result here. Here's the same information from the first slide. You can't use the safe harbor because you hired people during the COVID period. All right, let's look at this next example. We'll change a couple of things here in green. So the base period was the same, 10 people. The pre-COVID period was 10 people. Now, the COVID period, you actually reduced your employment by 2 people, dropped it to 8. And the covered period, you were still at 5 people. So you went down to 8 during the COVID period, and during your covered period, you further went down to 5. And when you applied, originally, you were at 10 people. All right, so let's see how this works. So step 1, during the COVID period, you had 8. During the pre-COVID period, you had 10. So you went from 10 to 8. You actually went down. So we will continue on with step 3, which would then take us to step 4. So in this case, based on the reduction, normally we would have a reduction in our forgiveness amount. Enter the borrower's total FTE. We would normally have a reduction. However, by the end of the year, this company was up to 20 people by December 31st. So that's one of the safe harbors. If you restore your employment, in this case, they more than restored it, then you would meet this safe harbor and your loan would not, you would get full forgiveness under this loan, which is step 5. All right, so basically, when you look at these numbers again, the end result is you can use the safe harbor because you laid people off as a result of COVID, and then you brought them all back and then some by the end of the year.
Yeah, so what we're finding is on the application, applies to many of the daycare, childcare centers that we work with, is that your number of FTEs actually did decrease after February 15th, but you were able to increase your FTEs by now, or you're planning to increase your FTEs. So again, going back to that bright line that Tony, you mentioned earlier, if you can get your FTEs up, you usually can apply for a safe harbor and not have to worry about the number of FTEs during your covered period, which means you get full forgiveness. So they really are trying to make it as easy as possible that if you really try to bring everybody back as soon as you can, you should get your application forgiven. So two applications that John's going to go over.
All right, so as you know, they simplified the process here between this easy application, which is just one page, very simple, and the more detailed application. So the easy application. So this applies to any Schedule C that has no employees. So if you're a sole proprietor with no employees, you can use the easy application. The bar also applies if you had no reduction in pay, so we looked at that earlier, and you had no reduction in FTE. So if you kept everything the same, you didn't reduce anyone's comp, and you didn't reduce anyone's, the number of employees you had, then you can use the easy application. No reduction in pay and also reduction in business. So the borrower did not reduce annual salary hourly wages by more than the 25% during the covered period compared to Q1, and the borrower was unable to operate during the covered period at the same level of business activity as before due to COVID.
And this is a question that actually just came up in the Q&A section of the webinar here is, how am I supposed to document that? And we get that question a lot, like, how am I supposed to say that I was unable to get back? And one of the things, like here in New York, they limited classroom sizes. Okay, well, there's a prime reason why you couldn't bring all your teachers back. Or, everyone was quarantined, mandatory quarantine, or whatever. That would fall into this category of documentation, and you'd say, hey, my teachers weren't allowed to come in because they had to care for children at their own house. So those would be reasons, things that you could do to document that.
All right, so back to the two options. So now the full application, as you see here, here's just an image of what the full application looks like. There's several pages. You have to include information on each employee and their compensation, and then both before and after. If there's any reductions, if you're applying for any safe harbors, including that. If there is a reduction, how that's calculated on the front page. So much more involved in this longer application. So if you're able to use the easy application, obviously you would use that. My guess is for most of you in your industry, you will probably have to end up using this full application.
And a little sneak peek of, too, is that in the HEALS Act and what the congressmen are talking about right now behind the scenes, we've been on a couple calls, Tony's been on a couple calls. They're hoping that if your loan's under a certain size, all you have to do is certify you did your best, and I'm paraphrasing, you did your best to pay people and bring everybody back to your best of your ability, and you won't have to fill out any of these applications. So again, it might be one more reason why you give it a couple more weeks, see what happens before Congress goes on recess. All right, so with that, just a little stimulus recap, some of the things that we've covered. If you have not joined us for every webinar, Tony's provided those recordings on his site. We've talked about a lot. We've talked about the PPP. That's what we're talking about today. We've talked about the economic injury disaster loan. We've talked about the SBA debt relief program, which many of you, if you have 7A loans or microloans or 504 loans, you have 6 months of your loan being paid for right now, which is great. And for any of you buying centers right now or in the middle of acquisitions, mergers, you might be able to get 6 more months of debt payments. We've talked about NOL carryback. So once you have a loss on your tax return, carrying that back 5 years and getting some money back that you could use right now. We've talked about the Main Street lending program, which is still in its early phases and beginning to be rolling out. And there's more coming down the pipeline. So we've delivered about $100 million worth of value to our clients over the last couple of months. It's, there's been tons of money out there. If you have not gotten the advice that you need, obviously, please contact us, and we'd be happy to review your situation. If we can help, we're happy to help.
So one of the things I wanted to add in, Dan, if you don't mind going back to that one other slide, just for those out there, want to let you know, for instance, with myself, I applied for a SBA Express loan, which I'm closing on actually this week. And because with the revenues I was planning to bring in this year, which I was not able to bring in this year, though, I was planning to put new flooring in one of my centers. I had to have a roof put on in a center, as well as I needed to look at adding some playground equipment to actually a third center. With those 3 items, those were capital expenses that I found were going to be challenging for me to get done this year because of it. But because of the SBA and the 6-month forgiveness they have with anything new, and I think it's still till the end of September, but you guys can correct me if I'm wrong.
Yep.
That I went for a loan with those capital items were about 80,000, and then I asked for another 120,000 of goodwill for cash flow. I am going to be able to get that loan for about 200,000 from the SBA through my local bank. I have already started giving them allocations for it, so they will be paying for those capital expenditures that I made. And then I have that 6 months of forgiveness, and candidly, the way that this one worked out, it comes out to I'll have about 57,000 of loan payment forgiveness. So of that 80,000 of capital expenditures, 57,000 of that will be taken care of for this. So that's just an example of how I was able to use it, because I did plan on having a number of capital expenditures this year. And one other thing is, just for everybody out there, I know that we've teamed up with Dan and John here. But they have been working directly with a number of our members, and I think they've really unearthed significant amount of opportunities. One of the areas that I think I didn't hear you guys before we get into Q&A, which I think is now your next slide, is we haven't talked a tremendous amount about tax ramifications. And going backwards and looking into some previous taxings, as well as how these things may affect taxes. What are your thoughts regarding any kind of tax elements outside of even PPP stimulus that you should be thinking about out there as one of the owners or operators who's on this call?
Yep. Yeah, I'll let John take that one.
Yeah, basically, I mean, right now the biggest tax issue everyone's going to have is that the PPP loan is taxable, like Dan talked about. So we're hoping that will change, come tax time, and maybe after the election it could change. We have no idea. But right now, you should be doing a tax plan to determine how much you will owe this year. Even if you feel like your year is down, it could be up with the PPP money. So you got to make sure you're running those numbers and reserving some of those funds for taxes. The other thing is there are some tax goodies like Tony mentioned. Do any sort of build outs in your properties. That's an immediate tax write-off now. That was part of the CARES Act that no one really knew a lot about. If you had losses in the past, you can carry those losses back now where you couldn't before. So there are definitely some tax items in this, in the stimulus package. The other thing, we're just waiting to see if when round 2 will come out. Because basically the industries that were hurt the most are still hurting, a lot of them. And the PPP money only got them so far, got them 2 to 3 months of cash flow. And now we're beyond pretty much those 2 to 3 months. So the next round of stimulus, unless we want the entire economy to completely blow up, and surprising it hasn't already, I believe that there will be a next round of stimulus here coming very soon.
Yeah, and I think one of the things that we're finding with some of the members as we talk to you guys and review tax returns, which we provide a free analysis of tax returns, and we just say, hey, send us your returns. We'll give you a quick summary of all the things that maybe you could have done differently. One of the main things we're finding is people not taking advantage of depreciating their improvements fast enough. You can take, in many situations, interior improvements as a deduction in the first year. If you missed that, we can certainly do amendments. We can do what's called a 3115, where we catch everything up in the current year. But if you missed that opportunity and paid more tax than you should have, there's nothing, the IRS doesn't want you to pay more tax than is required by law. And so all you need to do is file an amended tax return and say, I was owed this money, and you can get that back. So that's certainly one of the things we've been helping a lot of members with right now, is fixing those mistakes from the past.
Here's a question that came in regarding capital improvements. $25,000 capital improvement I need to do on the exterior structure of one of my centers. Should I apply for a loan through the SBA? That's more of a financial decision for you based on your situation. But if you do apply for a loan and you do use the SBA debt relief program, your first 6 months of payments will be covered by the SBA, assuming it's a 7A loan. So that would be one reason to do it, where the government would cover your payments. And when you actually recalculate the interest on that, knowing that the first 6 payments won't be paid by you, my guess is this would be a smart thing to do.
And John, just to add on to that, because I have the firsthand experience with that, I did my loan with a 2-year payback. So that drove my payments for principal and interest up, to almost $8,000 to $9,000 a month for a $200,000 SBA loan. So that gave me the most amount of forgiveness. They won't typically do under 24 months because they know that people are just trying to drive it up as much as possible. So the SBA is looking at it. There is always a chance, as my banker had mentioned to me, there's always a chance for an audit that they may come to if you don't have like the bills to back up the work that you're going to do. But if you have a capital improvement, this seems like, the SBA Express loan, which is a vehicle typically under like a 7A, but does not have the closing costs. And typically what you need is an SBA Express lender who, what that means for most of you out there is in your communities with a lot of the regional banks as well as larger banks, regional banks and larger banks, is that they have built up enough of a relationship with the SBA that they approve with guidance in-house to the SBA. So if you are able to find an express lender who can get you an express loan, which I think has now been raised up to $1 million, there is opportunity for those first 6 months of forgiveness.
Yep. Yeah, lots of goodies. And, again, hopefully some of the proposals in the childcare, in Congress right now are going to directly help the childcare industry, whether it's the allocation of money that goes directly to you, expanding PPP so that there's a round 2. So if your revenues went down by more than 50%, you'll be able to get a second round of it. So hopefully more on the horizon of stimulus.
There's a question here on just what types of SBA loans they are. So they are either current or new 7A, 504, or micro loans.
Yep.
And all this is on the SBA site. If you go to the SBA site and look under funding programs, you will see the SBA debt relief, an overview and some guidance and information on the SBA debt relief program.
Yep. And then there was another question on EIDL versus express loans, and the answer to that, yes, the EIDL is a different loan than the express loans. Express loans fall under 7A versus EIDL is an economic injury disaster loan. So again, thanks everybody for your questions, and obviously reach out to us. Tony will provide that information to you guys if you need. We're here to help. We've done a lot of these, a lot of applications, a lot of forgiveness consulting, and a lot of reviews of tax returns. So if you need anything, please let us know.
Yeah, so I'd like to thank the gentleman again for participating and being part of our program here. They've been very generous with their time, and I believe that with the program they have set up for us as part of our financial expertise, their generosity has extended on to our membership with doing an initial assessment. And I know right now that it's really, we found several areas that immediately are glaring where there's a lot of money that's been left on the table. We have a philosophy at Inspire Care 360, and that is, we have several philosophies. Unfortunately, I have a number of them too. But the one I'm talking about now is put your oxygen mask on first. And I'm a big believer that though many of us got into this industry for very much the right reasons of having amazingly cared for, educated, and secure children, if we put the oxygen mask on first and we understand how we can reinforce and build our business and optimize our business, we can then engage our team and we can then grow our business and do the things we need to, which ends up the end result means amazing kids. So a lot of the reasons we do these webinars, a lot of the reasons we partner with gentlemen like John and Dan, who really take some valuable time of theirs and bring it to us, is so we as an overall industry grow. So I would say definitely push on your senators as well as your congressmen, and let's see what we can get done. And this probably won't be the last time you see these gentlemen, but I want to thank you both for spending some time with us today.
Awesome. Thanks, Tony. Appreciate your support.
Thanks,
right.
Tony. Appreciate
Thanks
it.
for everybody. Everybody have a wonderful day. This will be on replay. We'll talk to everybody soon. Thank you very much.